Welcome back to Breaking Banks. I am your host, Brett King. And of course, Breaking Banks is the #1 global fintech podcast. I am coming to you from Dubai today, but it's great to have back on the show a guest that we've had on previously. It's been a couple of years now, certainly post-pandemic. But Varo Money is a unique player in the ecosystem in that they're really the only pure play digital bank that went the de novo route. Of course, they raised their first round way back in 2016. They achieved their license in August of 2020. Joining us in the studio virtually today is the founder and CEO of Varo Money, Colin Walsh. Welcome back to Breaking Banks.
Hey, Brett, it's great to be back. And yeah, it's been an eventful few years since you and I spoke. So I look forward to sharing more on the journey.
Yeah. So, first of all, give us a bit of an update about what's been happening the last year or so. There's a lot of really amazing activity. We hear a lot about profitability of challenger banks around the world now. Nubank has hit 100 million customers recently. So, tell us about how things have been going at Varo.
Sure. So, well, since we last spoke, which I think was the back end of 2021, so sort of a very different reality for our industry at that point. And it's been, as you say, a very interesting period of time. So I'd say first, we kind of had to navigate through the pandemic, and then saw some real hyper competition that was kicking in on the back of a lot of funding. There was a lot of activity in the market, and then that came to a screeching halt in early 2022 when the
Oh
funding
yeah.
markets dried up, interest rates started to go up. You saw some very high-profile bank failures with SVB and First Republic and Signature Bank, and then inflation started to spike, and so it's been a lot for the industry to navigate through. And I think from our perspective, we took some prudent decisions in early 2022 to sort of scale back sort of the grow at all cost model and focus on, how do we improve our unit economics, but how do we sustain investment in our technology platform, building a product that was going to be hyper relevant to our customers, and also leveraging the fact that we were the first and remarkably still the only fintech
Yeah.
operating in the U.S. with a de novo bank charter. And so how do we scale up our lending activities, thinking about how we monetize our deposits, and taking advantage of some of those kind of inherent capabilities from a business model perspective. And so I'm really proud to say, here we are now a few years later. We've had great growth metrics. We've been seeing sort of a 30% CAGR on the revenue side. We've brought our losses way down, as you mentioned, focusing on profitability and getting there soon. Also looking at just the overall unit economics and diversifying the revenue streams while building a product that is really relevant to the consumer, particularly as we look at this environment that the consumer that we serve, which is pretty much paycheck to paycheck, people who are trying to get by. They're making a lot of difficult choices in their lives, everything from, what do they put in their grocery basket to do they get their children new clothes for school? What are they going to do over the holidays? Are they able to take a vacation? I mean, a lot of these things that, quite frankly, manifested themselves in this election cycle in the US, where people were just saying
Yeah.
they're crying out for change and they're using the only sense of power they have, which is their vote. We'll see how that all plays out. But I say that it was really evidence that consumers have been under so acute financial strain. And so we've been working very hard to deliver the solutions that can be part of helping that very serious problem for many everyday Americans. And so we could talk a lot more about some of the specifics there.
I mean, you mentioned at the top of the show that you're the only bank that went that de novo route, and I remember even way back in 2012 and 2013 when Josh, who was the founder of Simple, of course, Bank Simple became Simple. We used to regularly catch up on the phone and talk about when there was likely to be a digital license or regulation emerged specifically for licensing a fintech bank or a fintech charter in the US. And I think a lot of people were holding out for that, especially given the OCC tried to introduce it way back in
Hmm.
2014, and it sort of hasn't happened. So, strategically, your decision looks pretty smart right now to have gone the de novo route comparatively, right?
Well, in hindsight, for sure. And at the time that we were considering the chartering options available to us, the OCC was, it was at a very nascent level, but was promoting this fintech charter, which never got off the ground. There just wasn't the political will to make that happen. And so we were assessing different options and decided to go with the full OCC National Bank charter, which, as you say, in hindsight, was a great move for us because if you look at what's happening particularly over the last couple of years, as regulators have been cracking down on whether it's third-party risk management or BSA AML, or other aspects of this operating model. Many of these sponsor banks have had their wings clipped and have been operating under some very intense regulatory scrutiny, which has a knock-on effect to the programs that they're supporting. And so our ability to manage our own regulatory destiny, which was one of the core theses, is that we want to be able to have the whole end-to-end from the regulated bank through the technology platform to be able to serve this massive TAM of consumers in the U.S. that needed a better bank. And you and I think, have a lot of simpatico thinking around that, just given all
Yeah,
the
yeah.
books you've written the work you've done in the space. And so this was really the kind of thesis from the beginning. And there were also other foundational benefits around thinking about unit economics and not having to share interchange, not having to sort of have a bin sponsor, being able to fund your deposits off of fund your lending activity off of low cost deposits and
Yeah,
not
yeah.
having to go source expensive capital market deposits. And then really at the core of it is also the amount of innovation you can bring across the whole range of things that matter to customers, whether it's around low cost free banking solutions, whether it's around moving money faster, building credit, accessing credit, building savings habits. And so all of that was kind of why we did it, and here we are now several years later, and we've been operating as a chartered bank for 4 years now. I would say it was absolutely the right decision, and but it has been hard for others who've attempted to go through that
Mm.
process for a variety of reasons. Now we'll see whether that changes over these next few years, but the barriers to entry have been quite high.
I mean, even just your capital adequacy requirements in the US, comparatives to, say, a fintech charter in the UK. Revolut just got their license in the
Hmm.
UK finally, as an example. It's a lot more work,
Hmm.
for a US de novo license. Of course, we also see a lot of consolidation in the market. You talked
Yeah.
about SVB and others. So there's always an opportunity to pick up, a bank in that consolidation mode. But that doesn't necessarily mean less work, does it?
That's right. And also, if you're picking up a small kind of community bank, you're not getting the tech. You're not getting the advantage of having a really agile, tech-driven platform. Um,
Yeah,
and,
yeah.
and and in the fintech side, you've seen massive amount of consolidation across the space. When you think of the number of players that were operating 3 or 4 years ago versus how many players are here today, it's a much narrower playing field.
Including moving, on the
Well, and
consumer banking side.
well, we took on board some of your customers when
Yeah,
you
no,
decided
that
to
we were
exit it. Yeah,
grateful. We were grateful to
yeah,
have your support at
yeah.
part of that, as part of that process for our customers. So it was great to have you, step up and be a good partner for us in that respect too. But the tech stack, I don't think that can be understated. The importance of that clean tech stack. I've been writing a lot about agentic, and generative finance
Hmm.
applications, and of late, of course. And this is sort of a key element of capabilities here. If you're going to sort of make this move into this sort of next generation of banking that's emerging right now, the tech stack's so critical, which ultimately means there's very few banks in the US that have the technical agility to sort of, make those moves right now, right?
This is one of the things that I'm actually most proud of. I mean, the team has done amazing work on a number of fronts, but the investments and the focus around building better technology to allow us to innovate at pace and be able to introduce products that really matter to our customers. I mean, first it starts with, just the proprietary data ownership, allowing us to make better decisions, being able to embed AI and ML into pretty much every aspect of the customer lifecycle right now, from account decisioning to fraud detection, to dispute adjudication, to credit underwriting, to customer servicing, and using that technology to have a real competitive advantage with our customers. We've also been able to build our own proprietary lending platform. So we now have three lending products. We've got our secured credit card. We've got our Varo Advance up to $500, which helps customers bridge cash flow if they have a shortfall in their to their next paycheck. And now we have the Varo line of credit, which is offering up to $2,000, which is really intended more for unexpected emergency expenses. But all of that's been built on our own proprietary lending tech stack. We've also now migrated, and we're in the process of actually rolling out a new app soon, where we're using React Native to collapse
Okay.
the Android, iOS, web development. So it used to, every time we wanted to introduce something, we'd have to develop it on three separate platforms. So now this is a
Yeah.
much more agile approach. Many of the leading tech companies are using these technologies to be able to move much faster into market. We also announced earlier this year that we're going to be going on to the MasterCard platform. So, that's going to be exciting as well, to partner with MasterCard. They've done some really innovative things globally, and looking forward to partnering with them. So those investments in technology, and to your point, being able to have an agile platform that allows us to respond quickly to changing customer needs, changing market dynamics, is a real competitive advantage. And if you look at some of the other big players out there, whether it be Nubank, whether it be Monzo or others, that have spent a lot of time investing in their technology to be able to have that nimbleness.
Yeah, this is the thing. This is why I love talking with founders of challenges. Because first of all, you haven't mentioned your core system once, right? You talk about your tech stack. You're obviously fluent in the tech that you're using, and this is the culture you really need to be a technically agile bank
Mhm.
these days. And like this is where we separate the men from the boys in sort of the next generation of banking stuff in terms of that technical agility. The next question I was going to ask, of course, is where are you using AI? But you just listed all those elements out. But
I'd also
um,
say I'd also say the women from the girls. So there's a lot of very smart
oh yeah, okay, yes, and
women that are helping
rightly
to
so,
drive
rightly
our
so.
ship. So I want to make sure
No,
we
rightly
keep an
so.
inclusive
Let's
environment. Yeah,
let's 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 indeed.
but one thing I would also add, though, from a cultural perspective, what do these tech investments afford us? So, we have, as we talked about, faster product iteration. We're able to go into an environment of continuous deployment. We can
Mm,
do much more rapid experimentation. I mean, we're running hundreds of experiments all the time to really figure out what is working best for our customers, for our marketing funnels, so on and so forth. Our teams feel more empowered, and that they feel like they actually can drive better customer outcomes because they've got the tooling, they've got the technologies that they need to make better decisions. And also it results in enhanced security and risk management, which right now, and we should probably spend a little bit of time talking about fraud, because it's a global problem right now, with banks and financial institutions, just given the sophistication of some of the fraudsters out there. So having a more modern tech stack allows you to fight that in a much more
it's so true.
sophisticated way. And then the operational efficiencies, so your ability to actually deliver at a very low cost, is largely determined by, how automated you are and how sophisticated your processes are.
Yeah, I don't think even many bankers are really across the fact that these are credit risk, which you've talked about lending, and we'll get into credit risk, but general fraud management. I don't think many traditional bankers are aware of how big the gap is opening up between technology players and traditional players in terms of managing this stuff. We see consistently now. You'll remember 10 years ago when we're both in the trenches trying to build our banks, And you would hear consistently from the traditional, segment of the market, these guys are never going to be profitable. They're only growing at with big growth numbers right now because they're so small, and they're never going to be able to manage risk as well as we can. And we know that those three elements are demonstrably false now. We know that challenger banks as a class, at least the ones that get to a certain critical mass, are performing better on all of those things. The operational cash efficiency is clear. Credit risk management tends to be better because it's a data modeling problem. Profitability is emerging across the segment right now. But let's talk about some specifics on that in terms of the lending stuff. Are you guys seeing benefits at scale now on the fraud and lending side because of the data models and because of the tech stack?
100%. I mean, so let's talk about lending, then we could talk about fraud. But there's two important areas that we focus on. So on the lending side, we have taken a very prudent approach. Not sort of the Marcus, like, let's put $3 billion of loans onto the books the first year without really knowing what we're doing, and that didn't go so well. But we have been very much around understanding our customer, and our customer, again, as I mentioned, is a paycheck to paycheck consumer, probably more in the non-prime space. And so being able to provide them with solutions that are meaningful to their lives, but where we're actually able to make the economics work and being able to lend into that segment is a huge competitive advantage for us. So we are, most of our lending is cash flow based. It's based on really understanding the dynamics and the relationship that we've established with the customer. We're using machine learning models to assess how much we can lend to customers and how to make sure that we're kind of very much at the top of that bill stack, because customers are, through making the right set of behaviors and building the relationship, they become eligible for more credit. And that becomes a very valuable lifeline for the customer. So, to me, having been in this business for so long, understanding the fundamental dynamics of, both capacity to repay and willingness to repay, and being able to create solutions that customers rely on in a responsible way, because that's the other piece of it. We also want to encourage customers to build small dollar savings. So if they have an unexpected expense, they can go to their savings first. But when they need lending products, that they know they can rely on us to provide those solutions for them. And so it's been a very thoughtful, considered approach. But we're scaling up our balance sheet. We're leveraging the ability to have low cost deposits to fund that balance sheet, and we're leveraging the relationships that we're building with our customers that are driving, what I would say is probably some of the best ARPU and contribution margin that you see in the market right now for a challenger bank, just given the depth of the relationship that we're building with these customers. So I'd say that the tech and the data and the ability to use machine learning models in effective ways has been fundamental for us to be able to grow and introduce new lending products. And I feel like it's still very early innings. I mean, I think about my previous employers. Lloyd's was around for 300 years. Wells Fargo and Amex over 150 years. We're still just getting started. And but I feel there's just that prudent approach in terms of how to go about making those lending decisions, particularly as we talked about in a very stressed financial environment for many consumers. And so I feel getting that right, particularly as the larger banks are constricting their credit boxes. So, with the CFPB about to regulate fees, and many of the, and also kind of signs of a credit cycle, many of the larger institutions are restricting who they'll lend to, which makes our proposition all the more appealing to consumers that are having a harder time accessing credit. And also, and we just actually did we have a press release coming out, some research that we just did that's showing just how, in so many ways, discriminatory some of these backward-looking lending systems are in the U.S. that are not taking into consideration people's, daily paychecks and their cash flow, just looking at mistakes that may have occurred in the past, and it's blocking people from being able to access more affordable credit and other solutions that could be available to them. So I feel like the whole lending space is ripe for further disruption, and players
Oh
like
yeah.
ourselves are in a very good place.
Don't even get me started on credit scores, dude.
Oh yeah,
I
no,
mean,
exactly. We could have a whole conversation on that. Yeah,
I
yeah.
relocated to Thailand recently, which I guess you know, and as part of the process of moving out of the States, I got my power cut off. I and they said, well, we'll send out the variance bill, if there's any, at the end of that. And they said, can you give us your forwarding address? And I said, well, it's Thailand. And they said, well, we can't send mail to Thailand, so you'll just have to check. And of course, I woke up one day with my 840 credit score down to 650 because I
Oh,
hadn't paid a
wow, because they were
$90.
reporting. Yeah,
Yeah,
wow.
right. And it's like it's so punitive, the system,
Yeah,
and
yeah.
like, but this is one of the things is we know now that credit scores are actually not a good predictor of default risk.
Well, and we're proving that because our
Right.
ability to lend to customers that many of the banks that are using these traditional systems would not even lend to, and being able to do it profitably. So, and I think that just is a big white space opportunity from my perspective.
So, what's the data model advantages here? Are you looking at cash flow, or what is it that's giving you that ability to assess risk in a different way?
Yeah, well, not only are we able to assess it, but we're able to help consumers understand how we're assessing it. So we're also using machine learning tools in our app to help customers understand if you do XYZ type things, like put certain amount of deposits in, your payment behaviors, if you're taking small dollar loans, that you're paying them back on time. And so we help customers understand like these are some of the factors that will help you get access to greater credit. So if you go into our app today, you click on, kind of your lending power, your borrowing power, it'll actually help guide you through what is it going to take to be able to access more credit. And again, when we start to get into larger amounts, we will start to take in third-party data as well. But it is a pretty reliable set of tools to help guide our customers in the types of behaviors that ultimately lead to responsible borrowing. And at the end of the day, we are a regulated institution. We're a mission-oriented institution that cares about improving the financial lives of our customers. So we want to make sure that the borrowing decisions that we make don't get our customers caught into a cycle of debt, and trying to help them actually kind of move out of that by also providing them with free banking services and better saving solutions and budgeting solutions so that they can manage their holistic financial life.
I've never really been a fan of budgeting. I don't think it works for most Americans, but I do think financial behavioral modification, as you're talking about, is very effective, far more effective than budgeting. Just because budgeting takes discipline that most consumers don't have. All you need
And
to
we've
do is check, people's doing New Year's resolution of getting fitter to see that the
yeah.
discipline's a problem, right?
Yeah, it's like going to the gym, right? Everybody shows up in
Yeah,
January and then never again. But what we've found is really helpful is not to create sort of a separate sort of PFM tool, but actually to embed it into the experience. So
right.
if you look at our debit card or our Believe, which is a secured credit card, customers can track where their money is going by category, kind of comparisons to previous month, and it gives them just sort of an intuitive set of tools. And they can also track money coming into their accounts as well and the sources in which that's coming in, and
Mm.
sort of a comparison of how is that against each month previously. So it gives them sort of that basic set of building blocks. And the other thing that we've invested in is taking what was essentially a dumb ledger, which most banks just simply have a list of transactions, and turning that into much more of a smart ledger that includes some of these visualizations, but it also allows more transaction enrichment that is helpful for customers. So, but it has to, in my mind, be embedded in the actual experience, the day to day. I mean, our customers are logging into their apps 94 times a month. I mean, like I can't even tell you how many times
Yeah,
I've logged into my Wells Fargo app in the last
yeah,
year, and it's like
true,
so
true.
there's super high engagement, but it's creating these things in the moments that matter for customers, and it's in the sort of click stream of how they're managing their money and thinking about their money. And for folks that don't have a lot of money, let me tell you, they are all over it. They understand where
Yeah, yeah.
every dollar is, and they're trying to move money into different sort of account structures to allow them to pay their bills. This is where things like, some of the pay by bank now is really interesting from a bill pay solution perspective. How they use their spending, whether it's and having intention around if I have a spending account that's helping me build my credit, that's really valuable. If I can put some money, if I can park some money in savings, I'm going to earn an attractive interest rate. I mean, we're still paying 5% on the 5,000 up to $5,000 for our customers. That's a lot of that's a high savings rate for people who typically don't even have a savings account. And so we're trying to kind of figure out how to manage the overall holistic experience. We like to call it like the financial operating system for our customers' daily financial lives, so
Right.
that all these pieces are put together in a very intuitive way. But this goes back to, the advantages of being a tech player, is that we can do this with a very consumer-centric mindset and have the tools and the building blocks to be able to assemble something that is highly intuitive for our customer.
That's the obvious play for where generative AI comes, I think, is when you can talk to your embedded AI financial coach and understand, can I afford to go out for dinner with my friends on the weekend and
Mm.
things like that. That to me is the obvious application, particularly as people get more and more concerned about stretching their money and making it work in in an inflationary environment and so forth, which is is something we've all experienced since the
And,
pandemic.
be, and really becoming that trusted partner for your customers, so that they, and to your point, through different technologies, through generative AI, through, we have a partnership with Amazon with our bot technology, which, captures about 58% of all inbound contacts through having these interactions with customers. It's more service oriented right now than sort of insights oriented, but we're continuing to look at how do we embed more of that sort of set of solutions that help with the jobs to be done, with the problems to be solved in a real-time basis for our customers.
That's fantastic. Let's talk a little bit about some of the growth specifics. Obviously, one of the differentiations that we see in the digital scaling capabilities of banks like Varo and other players in the space, Nubank and so forth, is this ability to scale digital acquisition and keep that cost of acquisition manageable. How have you guys gone as you've seen sort of the fortunes of this space over the last few years shift and weave?
Yeah, I would say we're probably a little bit different from some of the players out there that, I'm not going to tell you that we've got 50 million accounts yet. I wouldn't mind being able to tell you that sometime soon. We've taken a pretty rigorous approach to really managing our overall acquisition economics and looking at the different channels in which we're acquiring customers and how to do that as cost efficiently as possible, and looking at sort of both, a top of funnel as well as deep funnel metrics, and making sure that we're bringing in customers that really stick and that are engaging with us the way we want them to engage. So I would say, I still feel pretty good about our growth. I mean, we've more than doubled the size of the business since you and I last spoke. We've been running at about, sort of a 27% CAGR from a growth perspective. So I mean, we're still definitely growing this business, and I do feel like Varo is well placed now to, with the product solutions that we have and the technology that we have, to become a major force inside the U.S. banking industry, and also with the focus on financial inclusion and bringing financial opportunity to this huge TAM of consumers. But we think about, again, using a diverse set of channels. So our organic is, probably about 50% of our acquisition is just coming from those organic customers finding us, wanting our product, hearing about us through others. We test a number of different paid acquisition channels. We have solutions like Borrow to Anyone, which is where anyone on the Varo network can send money to anyone with a U.S. debit card, and they can receive funds, and then they learn about Varo and they can apply for Varo. So it creates some network effects. We have a strong referral program. We work with affiliates. So we've got a very diverse set of channels that we work with. But I do feel that scaling in a responsible way, particularly because once you join Varo, then you have access to a wide range of solutions, and including credit solutions, and we want to make sure we're attracting the right audiences. So I'd say we've taken quite a disciplined approach to this to make sure that, again, the unit economics look great, the acquisition economics look great, and I just feel like, as I mentioned earlier, we're in such early innings from taking the business now to becoming one of the bigger forces in the U.S. banking industry.
So on the LTV side, obviously the lending and credit stuff has helped. How do you see that engagement you're trying to foster manifesting itself in terms of lifetime value?
Yeah, so we continue to see we look at our ARPUs, we look at our contribution margins, we look at our duration for our customers. But I would say that like our what we call our North Star customers, these are our primary banking customers. We're generating ARPU north of $600 for these customers, and for a
Wow.
mainstream customer, I mean like that's like you
Yeah,
just
it's
don't really see that in other fintechs and really even in traditional banks. And again, that's
and you're
driven
not
those.
having to pay $350 to get a checking account either, like
No, no,
some of the
not
big
at
banks
all.
are, right?
Yeah, exactly, exactly. But this is also where, for our standpoint, it's important to look at those kind of payback periods and those CAC to LTVs and make sure those acquisition economics are very strong. And so we spend a lot of time thinking about that. And again, it goes back to sort of the fundamentals of building a business like this. It does require discipline from a P&L and a financial management, discipline from a risk management perspective, and understanding the risks that we're taking on and that we can responsibly manage them in our business in a way that we continue to build credibility with our regulators. And then it's about, creating the solutions that customers love and are very grounded in the kind of core pain points that the customers are trying to solve in their daily lives.
So you've spoken openly about your intent to IPO the business at some point in the future and so forth. Of course, I think that's a logical a target for every challenger in the space. And you must be getting close to profitability now.
Yeah, so I'd say that there's a couple things from that perspective, on the IPO side. One, let's see what the markets do. So, we welcome the fact that Klarna has now listed. I know Chime has spoken
Yeah.
openly about wanting to do an IPO. So, we'll let a few others go first and see how they do. But, I'm hopeful that, we'll start to see that IPO
It's all about the
market,
timing.
yeah, exactly, reopen, and that the stories that we have to tell are going to be very attractive to public market investors. I also think from my perspective, we probably have a little more runway before we're ready. The company itself is ready. So, to your point, we do want to cross that profitability milestone, which we see in the horizon. So we're excited about that. So, and I think once we're operating as a profitable, sustainable institution that's generating its own capital, that has a track record of, repeatable, predictable growth with strong unit economics, strong acquisition economics, facing into a very large TAM of customers, I think we'll have a very compelling story. So, but whether I don't see it as a 2025 event, but we'll keep
Sure.
all of our options open. And yeah, I think that our plan A is at some point to become a public market company. And I'm
And
excited to go.
no, I was just going to say, that makes sense. I think, there's some metrics that are fairly obvious as a precursor to that. But, we talked about consolidation in the larger banking space, which is only going to continue to speed up, most likely. Could you see yourselves acquiring, some businesses? We saw a new bank acquire Hyperleap recently for
Mhm.
AI competency. Is this something you consider?
So we think about it, and and we certainly haven't had any shortage of things that have come our way. I'd say that we've again taken a pretty disciplined approach in terms of how we would filter those opportunities. So one criteria from my perspective needs to be that it's got to be accretive from in a number of different ways. One is it's got to, not, we don't want to inherit someone else's burn rate. So from a capital and from a revenue and a profitability perspective, it actually has to move us further along, as opposed to pulling us back and consuming capital. So I'd say that would be one thing. The second is, could it be a source of distribution? So either there's customers that are similar to ours with similar products that could be converted onto our platform, or are they offering products that are on our roadmap that we haven't built yet that might be an interesting adjunct that could add on to the product set that's aligned with our roadmap? Or do they offer some sort of a unique access to customers, whether it's through embedded employer relationships or third-party relationships that could open up new channels of distribution? So we look at kind of all of those dynamics. And so I think that, at some point, would we, consider consolidating? I certainly wouldn't rule it out. I'd say for us right now, we've got, a very clear set of priorities that we're executing against. And obviously turning to profitability is going to be super important. So I doubt that we would probably do anything
Mm,
prior to that.
until that
But
point, yeah.
but we keep a close eye on the market and the dynamics in the market. And I think there will continue to be opportunities out there.
Speaking of which, we've just had a pretty dynamic change in administration in the United States. And, I think we can see with the consent orders and the lack of a fintech charter that regulators have not been particularly friendly to fintech banks in the United States compared with, the G20 and Eurozone markets that all pretty much have fintech charters. But what do you think the change of posture, if any, might be from the Trump administration in respect to the role that fintechs in generally play in the market?
Yeah, well, I definitely think you're going to see more pro-business, pro-tech. How that translates into, actual changes in policies and regulatory structures and prioritization inside the regulatory agencies remains to be seen. But I do think you're going to see more of a tailwind for things like, bringing in new charters, driving more technical innovation, and so I do expect that you'll start to see some changes, certainly in the next year or two.
All right. So then, what's up next for Varo? I know the
Yeah,
IPO
well,
is a little bit off, but what are you working on the next 12
we
months or
are
so?
just plugging away. As I mentioned, we're launching our new React Native app. Sorry, can't speak this morning. And we've got the MasterCard migration. We've got a number of feature enhancements just to continue to create the best possible banking, savings, lending solutions for our customers. So there's a lot on the roadmap, and we're excited to just continue to lean into this opportunity. Where, as we started this conversation, that we're at a cultural moment right now. Customers are feeling a lot of financial stress. That we want to be part of the solution and bring something into their lives that helps them feel more control, helps them see their financial health improving, and we think that this is a very unique time for players like us, as well as we've come so far from both a product and a technology perspective over these last few years that we're just excited to lean in.
Absolutely. Well, Colin, thanks for joining us on the show again. For those that want to find out what's happening with Varo, as a business, and follow you particularly, where can people go?
Yeah, you could always visit us at varomoney.com, which is our website, and we also have, learning centers and blogs and other things that are available from a content perspective. And you can also follow me on LinkedIn, and yeah, then appreciate the opportunity, Brett, to catch up and to chat about all these topics. There's a lot happening in our industry right now.
Well, all I'm going to ask you is when you are ready to announce that you've hit that profitability mark, make sure you come back on and tell us, okay?
I sure will. I'll
Because
give you a
there's
call.
something we can celebrate, okay?
Absolutely. All right. Sounds
All right.
great.